Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. Today, we're doing a deep dive into a stack of articles from MarketWatch, CNBC, Bloomberg, and others.
Yep, we're cutting through the noise on global markets, economic forecasts, corporate news, geopolitical shifts, really trying to get to what matters.
We've got everything from concerns about the U.S. dollar and, global carry trades to the race for AI dominance and some specific corporate dramas.
Our mission, as always, is to pull out those surprising facts, the key insights, and help you understand the connections you might not see just skimming the headlines.
Okay, let's start with a quick look at how the markets are moving right now and what everyone is watching this week. We're pulling from reports from CNBC and MarketWatch here.
Yeah, so U.S. stocks had a pretty solid Tuesday. They snapped those losing streaks we'd been seeing for the S&P 500 and the NASDAQ Composite.
It was a strong bounce back, definitely.
The S&P 500 finished up, 2.05%. NASDAQ jumped 2.47%, and the Dow added 1.78%. So gains across the board, maybe some relief buying or positioning ahead of the big events.
And as Yahoo Finance noted, U.S. futures were kind of little changed heading into Wednesday, just sort of waiting.
Right, holding pattern. And over in Asia-Pacific markets this morning, according to CNBC, it was, a mixed picture.
I guess so.
Well, Japan's Nikkei and Topix were trading mostly flat. South Korea's Kospi, though, that was up sharply, like 1.25%.
Okay.
Australia's ASX 200 dipped slightly, about 0.13%. Hong Kong's Hang Seng was also down 0.5% or so, while mainland China's CSI 300 was basically flat, a real patchwork across the region today.
So what are the absolute must-watch events on the calendar? What's driving this cautious posture?
Well, the big one. The one dominating headlines across MarketWatch and CNBC is the NVIDIA earnings report. That's due after the bell today, Wednesday.
Right. Seen as the key test, not just for NVIDIA, but for the whole tech sector, right?
Yeah.
And that broader market rally tied to AI.
Exactly. Huge focus there. And it's not just corporate news. Crucially, the minutes from the Federal Reserve's May meeting are also due this afternoon, U.S. time. CNBC highlighted that one.
Yeah, everyone's going to be poring over those details, looking for any clues on the path of interest rates,
For sure. And the economic data keeps coming. We've got GDP figures out Thursday, and then the Fed's preferred inflation measure, the PCE index, on Friday.
Also, critical data points, as CNBC pointed out, for understanding the backdrop the Fed is reacting to.
Meanwhile, shifting gears slightly but staying on global factors, Bloomberg reports that OPEC Plus is meeting this week, reviewing production quotas.
And there's been talk, right, in preliminary discussions about maybe a large hike in production.
That's the word, which would obviously impact energy prices.
And oil prices have been reacting. Bloomberg and Yahoo Finance noted they're swinging near, $64 for Brent and $61 for WTI.
Yeah, traders are weighing those potential supply increases against geopolitical risks, particularly involving Russia. It just adds another layer of global volatility to the whole mix.
Okay, so we've seen this positive bounce in U.S. stocks this week, but it feels like that's happening against a backdrop of some pretty significant structural concerns lurking beneath the surface.
Totally.
One piece that really grabbed my attention was from MarketWatch. The title was, "A Dollar Crunch is Looming, but Probably Not Until Next Year," says strategist.
Yeah, I saw that. It's fascinating because it puts a specific timeline on a risk we've talked about before, but maybe more vaguely. This strategist, Englander, is pointing to 2026.
2026 is potentially the crunch year for the U.S. dollar and for U.S. assets that are heavily reliant on foreign investors.
And the fundamental issue he's highlighting is something we've seen developing, but maybe reaching a critical mass now. The dramatic increase in U.S. external indebtedness over the past decade. We owe a lot more money to the rest of the world.
Exactly. And that reliance on international investors means if they start to get reluctant to buy our treasuries or hold dollars.
It won't be a small ripple.
No, it'll be felt very painfully and very rapidly here in the U.S.
The article notes some interesting market action already this year that might be hints. The 10-year Treasury yield, it's down 15 basis points year to date, though it's been volatile.
Right.
But more strikingly, the U.S. dollar index has dropped a significant 8% in 2025.
Though, interestingly, CNBC noted U.S. Treasury yields actually inched higher just this morning, Wednesday morning, as investors were monitoring those trade talks.
Shows how quickly sentiment can shift day to day, even within that bigger structural trend.
MarketWatch also brings up that recent big, beautiful bill that passed the Senate. While politically significant, a lot of economists think it's actually going to add to the deficit.
Right, not alleviate concerns about fiscal sustainability,
Yeah.
potentially worsening the underlying debt issue.
And Englander argues this growing concern about U.S. fiscal health is going to lead to rising risk premia for the dollar and U.S. bonds. Meaning, even if the dollar weakens and our assets get theoretically cheaper for foreign buyers, the perceived risk of holding them could increase, so they might still be reluctant to invest here.
And the article really stresses why foreign investors are so crucial right now. Domestic investors in the U.S. simply aren't saving enough to fund the government's borrowing needs. We need that overseas capital.
It reminds me of that Hemingway quote about going bankrupt.
Gradually, then suddenly.
Exactly. Englander cites that, suggesting the rise in U.S. national debt has been gradual, but the point where it triggers a crisis or a crunch for foreign funding could be sudden. Maybe 2026.
So for those international investors to keep buying our debt in dollars, they need reassurance that their returns won't be eaten away by inflation or, currency weakness.
And that comfort level seems to be eroding.
And here's a really surprising point from that MarketWatch piece. Even if the Fed were to cut interest rates, it might not necessarily bring down long-term rates if foreign buyers are being put off by this rising risk premia.
Well, we saw a hint of that in April, didn't we? Higher rates didn't boost the dollar as expected. Suggests maybe a lack of conviction from abroad?
So what could potentially delay this crunch point? Is it a foregone conclusion?
Well, Englander suggests in the article maybe a lack of genuinely convincing alternative investment destinations for that scale of global capital.
So where else do they put the money?
Right. Foreign investors might be hesitant to just dump U.S. assets if there aren't clearly better or safer places to go.
They might also be waiting to see how things play out, tariff wars, tax policy, deregulation packages over 2025 under the current administration.
It's a complex picture. Global finance intertwined with U.S. domestic policy uncertainty.
Okay, speaking of global finance and interconnected risks, another significant area of concern highlighted in the sources is what's happening with Japanese government bond yields. CNBC has been all over this.
That's a big one, yeah. Japan's long-dated government bond yields have been steadily moving higher. The 40-year yield actually hit an all-time high last Thursday.
Wow.
And yields on 30-year and 20-year debt are also up significantly this year. Demand for those 40-year bonds was reportedly the weakest since last July. That's telling.
And the feared consequence here is massive. It could spark a wave of capital repatriation.
Meaning Japanese investors pulling funds, potentially trillions of dollars, from the U.S. and other global markets back home.
And this ties directly into the concept of the carry trade, right?
Exactly. For years, Japanese investors borrowed in yen, which had super low interest rates, and invested those funds in higher-yielding assets elsewhere, particularly in the U.S.
Right. But rising Japanese yields and a potentially stronger yen make that whole trade much less profitable, maybe even risky.
So an unwind of that carry trade could be incredibly disruptive for global markets.
And some strategists are painting pretty dire pictures. CNBC quoted Albert Edwards from Societe Generale, suggesting this could, quote, trigger a global financial market Armageddon.
Armageddon, wow.
Yeah. And David Roche, another strategist, warns of a loud sucking sound in U.S. financial assets. I mean, Japan is the world's second largest creditor nation. Their movements matter hugely.
Roche also points out in that CNBC report that higher yields in Japan translate to increased borrowing costs globally, potentially reducing world growth, extending the bear market we've seen in many assets.
And Japan's net external assets hit an all-time high last year, $3.7 trillion. So the potential scale of repatriation is just enormous.
So why are these yields rising in Japan now? What's the driver?
The CNBC article points to a few factors. Japanese life insurance companies have largely met their bond buying requirements for the year.
Okay.
The Bank of Japan is scaling back some of its bond purchases. And importantly, there's a lack of private buyers stepping up to fill that gap.
So a confluence of factors.
Seems like it. However, it's not a unanimous view that this will be a catastrophe. There are differing viewpoints presented.
Like what?
While Guy Steer from Amundi is cited saying the gap between U.S. and Japanese short-term yields is smaller now than last year, and a depreciating dollar means fewer short yen positions. That could lessen the impact of an unwind, potentially.
Okay, makes sense.
And Ricardo Rabanado from EDHGC Business School suggests it might be more of a progressive erosion of capital flows rather than a sudden implosion.
So slower bleed versus a crash.
Maybe. And Masahiko Liu from State Street brings up the U.S.-Japan alliance, suggesting less risk of outright divestment because of that relationship.
Interesting geopolitical angle.
He also notes, using data from Torsten Sluck at Apollo, that foreign holdings of U.S. assets are actually concentrated more in equities, $18.5 trillion, than treasuries, which are $7.2 trillion.
So any outflow might start with stocks.
That's his view, which might be less disruptive to bond markets initially, perhaps.
It's clear from these reports, though, that while the risk is being debated in terms of scale and immediacy, the fact that strategists are even mentioning Armageddon shows the level of underlying anxiety about these structural shifts.
Definitely something to watch.
Okay, let's shift gears now to a broader theme running through several sources: global trade tensions and the intense uncertainty they're creating. Recent news here has been a bit of a mixed bag.
Right. On Tuesday, U.S. stocks got a boost. Yahoo Finance and CNBC reported this. President Trump announced he was delaying that implementation of a 50% tariff on EU imports until July 9th.
And that delay reportedly came at the request of the European Commission president.
That's what was reported, yeah.
And CNBC's coverage on Treasury yields noted that investor optimism did get a bit of a boost from hopes this delay could signal more potential trade deals down the road, seen as a positive step, however temporary.
But contrast that cautious optimism with what we're seeing regarding sentiment towards China. A CNBC report highlights that European business optimism about doing business in China has hit its absolute lowest level on record.
Wow, lowest ever. Even worse than during the pandemic.
Apparently so. That comes from the EU Chamber of Commerce survey findings. A staggering 73% of respondents said doing business in China became more difficult just in the past year.
73%, that's huge.
And optimism about profitability is at a record low. Fewest companies ever ranked China a top investment destination, record low planning to expand there. It's a really stark picture.
What are the challenges they're citing?
Numerous things. Slower growth in China itself, geopolitical worries, ongoing market access restrictions, regulatory hurdles, increased competition from local Chinese brands, lackluster consumer demand.
Even discrimination.
Yeah, even reported discrimination favoring domestic players in certain sectors. And the CNBC article noted this echoes findings from a similar survey of U.S. companies operating in China.
So this has real implications for supply chains, right?
Absolutely. The survey found that while China remains dominant for low price quality manufacturing, some companies are actually increasing onshoring to China for localization purposes.
Oh, interesting. Not just leaving.
Not entirely, but almost half of the respondents also said their Chinese suppliers are moving operations to other markets outside of China. So it's not a simple story. It's a complex reconfiguration happening.
This really brings us to Mohamed A. El-Erian's opinion piece in MarketWatch. Provocative title. Growing economic uncertainty means you should do this one thing with your money now. He offers a compelling framework here.
Yeah, I read that. He views 2025 as a year characterized by extreme policy-induced volatility.
And not just market volatility, right? He means volatility in economic narratives, international relations themselves.
Exactly. He points to things like the S&P 500 nearing a bear market, then recovering sharply, or U.S. recession probability forecasts swinging wildly, symptoms of this policy-driven uncertainty.
And his key insight, which I found really important, is that tariff volatility, while disruptive, isn't the root cause here.
It's an accelerant.
Right. An accelerant for bigger structural changes that were already underway, like diversifying supply chains, companies prioritizing resilience over just efficiency,
National security concerns trumping purely economic ones.
and an erosion of confidence in global institutions and predictable policy.
And the debate around trade policy itself just feeds the uncertainty. Was that recent EU tariff delay a strategic move towards escalate to de-escalate, aiming for a fairer system, or just a temporary pause before more difficulties? We don't know.
El-Erian describes a tug of war within the administration, between more dovish economic officials favoring deal-making and hawks who think short-term pain is necessary for national security goals, even if it means trying to derail China's development.
He identifies 5 key issues that he thinks will determine where this period of uncertainty ultimately takes us.
Okay, what are they?
First, tariffs themselves. Second, the bond vigilantes return. Third, that ongoing tension between economic and national security considerations. Fourth, how other countries react will they question the U.S.-centered system. Loss of U.S. credibility.
And fifth,
Corporate behavior. Are companies just stocking inventory short-term or making fundamental long-term changes to their global footprint?
he frames the uncertain outcome as either fragmentation of the global order or potentially a beneficial rewiring towards greater productivity and stability in the long run.
But either way, he concludes, it's a bumpy journey. Resilience is needed to navigate this prolonged period of uncertainty.
Definitely a sobering perspective. Okay, let's narrow our focus now to the tech market. Clearly central to the headlines, particularly the huge anticipation around NVIDIA's earnings today. MarketWatch, Yahoo Finance, CNBC, all highlighting how big a deal this is.
The context here is important. We saw those mega-cap tech stocks, the Magnificent Seven, stage that massive comeback in May after a really harsh fall following those early April tariffs we just discussed.
The MarketWatch article on NVIDIA's earnings laid out the numbers. The Mag 7 collectively lost $2.12 trillion in market cap between April 2nd and 8th?
Crazy number.
But then added a staggering $3.7 trillion back between April 8th and May 14th. Incredible volatility in the market's biggest names.
And even with pretty high valuations, tech is being seen by some investors as relatively safer right now. Melissa Brown from SimCorp is quoted in MarketWatch suggesting their business models are pervasive, they're delivering on earnings.
And crucially, fueled by optimism around AI spending.
Right. The influence of this group is just undeniable. Jeff Buckbinder from LPL Financial notes in MarketWatch, they're driving nearly half of the S&P 500's overall EPS growth.
And have projected collective capital expenditures around $330 billion for 2025. That's serious investment.
Beyond the giants, though, CNBC's Wednesday's Big Stock Stories and Yahoo Finance flagged other specific company news, gives us a feel for different parts of the market. Okta, for instance.
The identity management software company.
Yeah, their shares dropped after hours despite beating earnings. Why? Customers are hesitant to spend on software right now.
Meanwhile, Fair Isaac, the FICO score company, its stock fell sharply after criticism from the FHFA director about fees. Government and regulatory pressure matters.
Clearly. On the brighter side, GE Aerospace and GE Vernova shares are trading near highs. Vail Resorts climbed after hours on CEO news. Macy's also has earnings today. Meta Platforms has its shareholder meeting.
And we can't forget Trump Media, DJT. CNBC reported they announced plans to raise $2.5 billion for a Bitcoin treasury.
Yep. Unsurprisingly led to volatile share price movements.
These individual stories, they really reflect the very dynamics at play beneath the market surface.
Which brings us to a fascinating and somewhat counterintuitive MarketWatch article titled, "Please Shut Up If You're Trying to Make Money in the Stock Market."
Huh. A bold title. But based on some interesting research into investor behavior.
Exactly. The study they discuss looked at social media posts, stock twits, Seeking Alpha X. It suggests the more people are chattering online about the stock market, the worse future stock market returns tend to be.
Really? Over what time frame?
Over the very near term, specifically the next 20 days.
Interesting. And bad news drives more chatter than good news.
That's what they found, linking it to behavioral concepts like loss aversion. It implies that collective online noise might actually be a negative indicator for the short term.
This ties into another MarketWatch piece, doesn't it? Retail investors aren't scared of the stock market. That will only make the sell-off worse.
Yeah, the concern here is centered on retail investor behavior. They've been aggressively buying the dip, especially after that early April market drop.
According to JP Morgan estimates cited in the article, April was one of the most aggressive months of buying by retail, accounting for a significant chunk of daily volume.
Something like $50 billion poured in since April 8th.
That's the number. And the contrarian view, which the article highlights using analysts and data like Shiller's Buy on Dips Confidence Index, is that this widespread willingness of retail investors to immediately buy every dip
is often a characteristic of market tops.
Exactly. The implication, according to this view, is that because retail investors have been rewarded for buying dips recently, their stubbornness might mean it takes an even more severe downturn to finally shift their sentiment.
To create that kind of capitulation that typically precedes a major new leg upward, it's a potentially worrying signal for market health from that contrarian perspective.
Okay, from investor behavior, let's pivot to a key strategic and geopolitical theme dominating headlines: the global race for AI dominance. CNBC had a really insightful article. The U.S. AI love affair with the UAE boils down to dominance.
This piece really lays out the core dynamic driving this partnership. It's pretty straightforward, actually.
How so?
The U.S. has the companies making the most advanced AI chips, like NVIDIA. The UAE has abundant, cheap energy needed to power the absolutely massive data centers required for AI.
Ah, the power demand.
Yeah.
Right, it's a seemingly perfect match.
And the scale of investment is huge. Hundreds of billions of dollars already committed between major U.S. tech firms, NVIDIA, Microsoft, OpenAI, and key UAE entities like G42, Mubadala, MGX.
The article mentions the Stargate UAE AI campus project, aiming for $500 billion in private investment.
Yeah, massive numbers. And the strategic alignment is very clear. The UAE wants AI supremacy to boost its global influence, move its economy beyond oil. One analyst called it compute, not crude.
Catchy. And the U.S., under President Trump,
Wants American firms at the forefront of the global AI race. Wants U.S. tech standards spreading globally.
There's been a recent policy development that reflects this, discussed in the CNBC article.
Yeah, the Trump administration planning to rescind a Biden-era rule that put strict export controls on advanced AI chips, even for U.S.-friendly nations.
Which is debated, right, because of the risk that sensitive tech could still indirectly reach rivals like China, even through partners.
Exactly. The example of the Emirati AI company G42 is a really concrete illustration of this strategic choice they made.
What did they do?
They completely divested from Chinese companies, including their stake in ByteDance, the owner of TikTok, specifically to ensure they'd maintain access to NVIDIA chips and other critical U.S. tech.
Wow, a very deliberate shift.
A calculated decision, as the article highlights. Shift focus from China to the U.S. because NVIDIA makes the best chips, and the core semiconductor supply chain is mostly in Taiwan. Access to that tech outweighed their China investments.
The broader implications are significant then. This alliance helps the U.S. shore up its supply chains, potentially constrains China's access.
Gives the U.S. an edge in what's increasingly seen as an AI arms race. The U.S. is actively working to deepen its technological presence in new markets like the Middle East to push its tech globally.
It's even framed ideologically sometimes.
Yeah, the CNBC article quotes someone positioning OpenAI as a potential countermeasure to China, offering a U.S.-led small democratic AI system as an alternative to a China Communist Party-led one. Highlights just how intertwined tech, economics, and geopolitics have become.
Okay, before we wrap things up, let's quickly pull together a few mentions of Elon Musk that appeared across the sources this week. He's always in the headlines somewhere.
Never dull. CNBC reported he announced on X, formerly Twitter, that he's returning to spending 2047 at work and needs to be super focused on his companies.
And investors seem to react positively. Tesla shares up almost 7% on Tuesday, according to CNBC.
Yeah, the report noted his political involvement had reportedly been affecting Tesla's reputation and sales, particularly in Europe. So maybe a refocus is welcomed.
Meanwhile, SpaceX had another Starship test flight on Tuesday, their 9th overall.
And CNBC and MarketWatch both reported it experienced another rapid, unscheduled disassembly.
SpaceX's term for exploding happened during re-entry, their third consecutive setback for the full stack test.
The details are interesting. Suffered a major fuel leak, spun out of control, broke apart. Also, a door failed to open fully, nixing a plan to release mock satellites.
Musk, however, characterized it as a big improvement, according to the sources.
Right. Emphasizing it, made it to the scheduled engine cutoff during ascent, didn't lose significant heat shield tiles on the way up. Their definition of success in these early tests seems focused on hitting milestones and gathering data, even if the end result is, well, dramatic.
He's clearly still committed, vowing to increase the Starship launch cadence significantly, aiming for roughly one launch every 3 to 4 weeks.
Now that they have recent FAA approval for increased launches from their Texas site, the company line is that success comes from learning. They're certainly getting a lot of practice with that.
And the sources also include the detail that Musk leads the Trump administration's Department of Government Efficiency, DOGE, and a federal judge recently affirmed this role is continuing and permanent.
And notably, CNBC pointed out the Trump administration has reportedly reduced resources for the agencies overseeing Musk's companies. While SpaceX is a major government contractor, a front-runner for things like the Golden Dome missile defense shield,
just highlights this really unique, complex intersection between his corporate ventures and his government role.
Definitely. Just a couple of other quick notes from the headlines this week before we wrap. Bloomberg mentioned President Trump's statement on Fannie Mae and Freddie Mac,
saying the government will maintain implicit guarantees and oversight even if they go public.
Exactly. That reportedly eased some investor worries in that space.
And from CNBC, down in Australia, inflation came in at 2.4% in April, slightly higher than estimates, following the RBA's recent second rate cut this year.
And New Zealand's central bank cut its benchmark rate again, 6th straight time, by 25 basis points, expected, driven by easing inflation and spare capacity. NZ dollar strengthened slightly, just shows the varying monetary policy environments globally.
Okay, so Putting all of this together, looking across these sources, what does it really mean? What's the big picture?
Well, it's a complex picture, isn't it? Global markets right now. On one hand, you've got that cautious optimism, reflected in recent U.S. stock gains, trade delays, the strong performance and investment plans from key tech players like the Magnificent Seven, especially as we wait for NVIDIA today.
Right. But beneath that surface optimism, we're seeing significant structural concerns being flagged. That potential for a U.S. dollar and asset crunch tied to rising debt and our reliance on foreign investors. That's a big one.
And it's compounded by the risk of a global financial market shock if rising Japanese yields trigger a significant unwinding of the carry trade, as some strategists are seriously warning about.
Exactly. And overlaying all of this is that intense, policy-driven uncertainty the Litterian describes so well. It's not just about tariffs. It's accelerating fundamental shifts in trade, supply chains, geopolitics.
That tug of war between economic goals and national security, how other countries react to U.S. policy shifts, whether corporations are making short-term tweaks or long-term strategic changes, these are the real determinants of where we're headed.
And we're seeing fascinating dynamics in investor behavior, too. From that research suggesting social media chatter volume might be a negative short-term indicator,
To the potentially contrarian signal from retail investors aggressively buying every single dip. Stubbornly, perhaps.
plus the race for AI dominance shown by that US-UAE partnership. It adds this massive layer of strategic competition where access to compute power and advanced chips is basically the new geopolitical battleground.
Even specific corporate stories, like SpaceX's ambitious test program and its ties to government contracts, they're part of these broader national capability themes.
It's just really clear we're in a period of significant transition with multiple potential outcomes. These sources, they don't give us a crystal ball, obviously,
Not at all.
but they certainly highlight the critical forces at play and the factors we really need to watch closely.
And this complex, uncertain landscape, it raises a really important question, I think, for investors, for businesses alike.
Which is?
In a world where traditional market signals might be less reliable, where uncertainty is kind of the new normal, how much should you lean on historical patterns and playbooks? And maybe more importantly, at what point do you have to accept that the fundamental rules of the game might actually be being rewritten right now?
Something for you to consider as you navigate your own decisions based on all this information. That wraps up our deep dive into this week's major financial magazine headlines. We hope you found some valuable insights to help you understand this complex landscape.
Remember, understanding the underlying dynamics, that's really key to cutting through all the noise out there.
We'll see you all tomorrow morning with new headlines from major financial magazines.